Hey guys, the Swing Trading Club here. We are currently looking at the Nasdaq after a pretty choppy week, a large downturn to close after a negative CPI print. So we're going to get into it all. We have FOMC meeting to head through. We have a lot to cover, so let's jump right into it. So first thing we're going to do is look at the Nasdaq. As I mentioned, that volatility was pretty low throughout the week, and then we had that huge negative CPI print, meaning CPI came above expectations. I think they were expecting, inflation to peak, like they mentioned a few months ago, and that is not what occurred. So market sold off, and we're going to get into it. But before we really get into that kind of economic report, I do want to just flip over to the daily chart of the Nasdaq here and just kind of really see how far we have come currently off all-time highs. And as we mentioned in our previous videos, when you're having this kind of capitulation event, it doesn't all happen at once, right? COVID was a different story, and you guys can kind of see these red markers that I put in for just the high and the low. COVID was a different story. It was about a very, I'd say, 3-week to 1 month kind of peak to trough, and I actually have a data point that I'll share with you guys here in a second that analyzes that, but it was a quick downturn. This one, like previous cycles, is going to be a little bit longer in my opinion, and there's going to be a lot of these kind of bounces, right? We're bouncing off 11,035 back up to 12,50, and then backing down. So expect a lot of these little bounces on the way down, guys. And one of my favorite things is to look at kind of some historical context here. So bear with me as I flip over to 2001. So before we get to 2001, let's talk through 2008. This is the peak to trough of this market, right? And we saw even here, right, it almost looks like you have a downturn. Our moving averages start turning around. All looks like we're going to have some light at the end of the tunnel. Another trough, another peak, and then extreme capitulation. So just be careful when we're trading in these markets that you don't get caught in one of these bull traps and just get crushed by the bears, right? So let's jump over to our 2001 real quick. So same thing for the tech bubble here, guys. Back in 2000, 2001, we saw a peak about 5,000, but that trough took a long time. I think it was 900 plus days where we really just got beaten down until most investors leave the market, and it then becomes a risk-on environment and slowly starts gathering momentum. So again, just to reiterate, there's a lot of these little bumps on the way down, so just be very cautious. And I want to bring your attention to one of some analysis I did, really just kind of back the envelope. And there's been this out there, but I did just kind of want to talk through this real quick. So just what I mentioned, right, the dot-com, global financial crisis, COVID, and then our current drawdown. I'm looking at the difference in delta, the difference in price, which is just, the delta, right? So in our dot-com sort of bear market, if you will, more or less 80%. Global financial crisis, about 55, 56%. COVID drew down about 33%. And our current drawdown as of market close at the end of this week was only about 30%. So again, this is the Nasdaq, and it just kind of goes to show you where we might be in this cycle, right? And then also look at that days at which full recovery occurred. Now this is kind of, again, sort of back of the envelope, and definitely not a very precise number. However, it gives you an idea of how long some of these market cycles can play out, right? These long downturns, we're really not too far into this yet. We're only about 190 to 200 days into it, and so we want to be careful not jumping the gun and re-entering this market too quickly. And now the last thing that I want to quickly show you guys is bring your attention to this table. So how far can we go, right? And what does that look like? Our peak was at about 16. That's in the Nasdaq. Now, if we go down 40%, that's going to hit this 9.7 mark, right? And we have 8, 6, 4, 3, 1, and 0. Obviously, we're not going to go to 100. I wouldn't even say 90, 80 are too high in the realm of probability. But, if we compare it to .com, right, you can make a pretty good argument that you could see an 80% downturn from the peak here, right? And that gives you a level of about 32.45. So just be careful, when you're re-entering this market and kind of how you think through where we are in the current cycle. And obviously this isn't telling the entire story, but just kind of be mindful of that, guys, as you go forward. So we're flipping over to the economic release that I mentioned previously, the Consumer Price Index. Now, this is grabbing it from the Bureau of Labor Statistics, and this is kind of their reporting style. So we're going to change screens just a little bit, but I do want to show you, it's good to know exactly where this report is and how it's getting distributed, and B, just exactly what these numbers are here, right? And we're going to dial in on a few of these, but I just kind of want to slowly tick through these and show you exactly what they're printing out. And if you guys want to pause that and just kind of look at those numbers, obviously just go to bls.gov and you'll be able to see this as well. But here's the actual report. So let's flip over real quick to a few key items that I think are important to talk through. One that we've had a ongoing conversation at least in the premium channel, is food prices and kind of what this looks like. So if we flip over to all items, and this is still on that bls.gov site, guys, and it's actually a nice little table that they put together for us, but we can look at the chart data. We can also look at just the interactive chart, if you will. But food prices are really on the rise, guys, and this is actually from May 17th, so this isn't even our last tick, right? It hasn't included May. But let's be understanding of what's going on here, right, guys? We have that obviously conflict in Ukraine, and there's a lot of fertilizer issues that I'm sure all you guys are aware of. And wheat is also a huge commodity that is being kind of throttled in that area. So you're seeing a lot of increases over the last couple months on the food side of things. Food at home is another big one. So really a 10%, and it does go back to this this other chart that we just showed you, right? 11.9% is the latest release. Again, this chart is just a few months old here. But just be mindful of all the different kind of items that they're looking at and see where does this fit into your overall thesis. And then if we kind of extrapolate that and say, all right, do we want to relate this one to a period like the 70s, the 80s, .com, wherever, right? You kind of get a barometer of where we might be headed and kind of what we can look for continued inflation. And a lot of folks are saying, oh, we hit the peak, but I don't see any signs of it slowing down. But we will see. So that's one kind of subset here, the food prices. And another one that I kind of want to talk through is just energy in general, right? We had energy tick up 50% and energy services 16.2. So if we click through this one, it's looking at fuel and oil, 106%, guys. That is that's pretty crazy. And 48% from gasoline and other types, right? So it's kind of eliminating between whatever kind of categories they decide. But guys, play around with this. Obviously I can't talk through this for an hour. Everybody would get pretty bored with it, I'd assume. But play around with it. Again, it's all on bls.gov, and they do a pretty good job of releasing all these reports. One last item I did want to hit on real quick, guys, is just the month-over-month change here from April to May in what they call fuel oil, right? So we're seeing 2.7 in April 2022 and 16.9 in May of 2022. So again, this is the seasonally adjusted changes from the preceding month. So big uptick there, guys, and just kind of wanted to point that out before moving on, that we're seeing large increases in oil, and you'll see that in some of our weekly picks and kind of how we are trying to think through our overall market thesis here. So another key report that I want to touch on is the consumer sentiment. Now, this is released from the University of Michigan. They've actually been doing it, I think, from early 70s is when they started putting this out. It's a pretty reputable report. And one thing that I think is crucial that we all talk through is the actual just print of it, right? This 50.2. This is the lowest it's ever been, guys. And this is well below expectations, and month over month change is really dropping dramatically, right? And we might even have more to go here, guys. So I want to flip over to just real quick. Actually, let's go over to the Fred database first. So what this is looking at is that exact report, but just on a graph, and so you can kind of see over the '08 period, right? Extreme downturn, global financial crisis. Everyone's pretty familiar with it. It only dropped to about 55, right? So we just came out at 50.2. Now this one doesn't have the latest updated number. It ticked up a little bit higher in April 2022, but the May and June will come out probably in the next couple months. This is kind of a little bit of a lagging database that this website publishes, but it's great for looking at overall data trends. Anyways, you saw in 2000, right? Nowhere close, right? We got down to 80. Even on 9/11, right? It didn't get crushed as much as where we currently are back in the 1990s. Even at the low point of the 1980s, right? Coming off the change of the gold standard back in the 70s, you had crazy inflation, kind of akin to where we are currently, and then just this huge market downturn. So kind of some similarities in that, but this is the lowest print for consumer sentiment, I think, in all of history, since they've been at least recording this. So, when the Fed looks to try to fight inflation and, how they kind of think through the economy versus inflation and where that battle is sort of waged, if you will, consumer sentiment is at an all-time low. So we got to be really careful with how we move through this environment, because there could be a lot more pain upcoming. So just kind of keep that in your mind. Next report I kind of want to just quickly talk through is just the crude oil and what we're seeing in those markets. I think it's pretty apparent to everybody that oil has been on an absolute tear. Now we need to think through what this means for the overall market. We're currently sitting about 120. We got up to 122 kind of intra-week. And so just try to understand the supply and dynamics going on here, guys. Supply and demand dynamics going on here. Biden, I think, is set to visit Saudi Arabia here in the next couple weeks. New York Times released a report, I think that would have been last Friday, that said he was kind of planning a trip to visit MBS and think through how we might be able to open some more supply. But we're at a really precarious time. We don't have enough reserves, and even if we did, it wouldn't drastically change the amount of kind of oil in the system in terms of driving the price down. There just isn't enough supply. So all these things kind of take time. And just so everybody is aware, we always trade the oil in futures markets, right? You're not paying kind of spot oil, if you will. So just to kind of give you a quick sense of what it looks like for July, August, September, October, etc., etc. So the market is kind of pricing in this potential drawdown, but definitely don't be, this can change on a dime. So let's see where this ends up, but I think it's always good to at least once a week just kind of check in on where oil is trading. Now, turning our attention to the bond market, we did see yields start to rise a bit. Again, price and yield are always inversely kind of correlated. So when we see yields rising, prices falling, at my old position in, I guess you could call it Wall Street, right, for lack of a better term, but I was working for a large investment bank, and we had a mortgage desk that we were interacting with very frequently. So these big movements, guys, this is going to really swing those kind of traders, and I don't want to ever push away the bond market. It's really the plumbing for the entire economy. And so when we think through only equities and only looking at the Nasdaq and only these high-flying growth stocks, we really leave a lot off the table if you don't constantly look at something like the Treasury markets. So just be mindful of that. I don't need everybody to memorize exactly where we are every single day, but just kind of understand what these markets are doing, where the 10 years at, where the 1 year's at, 1 month, 3 month. I like looking at the 3 month and like 18 month. It's a little bit harder to find on CNBC, but any Bloomberg terminal has it, TradeWeb has it. But just kind of think through what these indicators are and what kind of yield curves are derived from there, and that gives you a really good understanding of where, how the policymakers, specifically the Fed, are really going to be thinking through their next move. They're all looking at the bond market. Equities are always in the headlines, but bond markets are really what kind of drives it. So just keep in the back of your mind, guys. Now, I did quickly want to mention the mortgage applications decrease. Now, this is a MBA. This is just Mortgage Bankers Associations. They put out this weekly number. Real quick, just mortgage applications decreased 6.5%. Again, I wouldn't necessarily make your entire thesis off mortgage applications decreasing, but again, just a data point for us all to look at in terms of how we want to build our overall market thesis and think how long this current downturn could last, and what we should be looking at in terms of where to allocate our money and how to think through some of these changes that we're seeing happen right under our feet. So let's move on from this. And I don't want to paint too much doom and gloom, but I do see I'd say a potential for one of these large kind of capitulation events. So I wanted to take us back into a little bit of history. Most people would probably be familiar with Black Monday. It was back in 1987. I think it dropped 22.6% in one day. And that was the Dow, right? The Nasdaq, we typically see these big volatility swings. Not so much as the Dow, just because it's comprised of a little bit sort of a different of a bucket. But I'm not going to spend too much time on this, but I just want to kind of give you guys some context historically of what could potentially happen. And I'm not saying that to freak anybody out, but it's just a reminder to keep the stop losses on, understand that, as swing traders, and something that our premium group targets and discusses frequently is we never want to be, wiped out in one trade. You always just want to have these little wins, trade with momentum, watch the 5-day, the 9-day moving averages, and just ensure that you keep moving forward with these little trades. You don't need to make it all back in one trade, but just watch the stop losses closely, guys. And looking at the week ahead, the big meeting that we'll have that everybody's going to be paying attention to, kind of tunnel vision, if you will, is going to be this FOMC meeting. Jerome Powell is going to be speaking on Wednesday. We also have, I think, some retail numbers will come out as well. But the big one this week, obviously, guys, is going to be this the Fed meeting and what they decide to do with rates and kind of where Powell sees our current kind of status. And I think after this last print of CPI, there's definitely going to have to be some increased hawkishness. Now we'll see what comes to fruition there. In this last kind of article, if you will, is just sort of setting expectations and kind of what they're expecting in terms of a rate hike. It's likely, at least according to this article, that kind of depends how you want to look at the markets. I haven't seen exactly what they're pricing in, but it seems to be that they're set to have another 50 basis point hike. So we'll see. We never know. That could go more hawkishness and even raise by 100, right? There's no rules against that. I think if you see that, you're going to see a pretty large kind of drop in overall markets, but we'll see. So keep that on your radar for the upcoming week. So moving on to our recent winners, guys. ExxonMobil, this is a trade we put on a few weeks ago. It was in this channel formation, and these are one of my favorite formations to trade in. I really like just trying to catch it right off this bottom band and then play it to this top, which is exactly what happened. So if you stayed in that, it was a nice little swing trade for the club. Hope everyone took advantage there. And again, in this market, we always want to be keeping our stop losses super tight. So if we had a scenario where, say we got in, at this 96.5 mark and we dropped down, even if we broke down here, which, some people might want to play and, wait for the rebound, just cut it off, guys. Right? We can't afford to be losing 5-6% on these trades. The most you ever want to lose is, in my opinion, about 1 to 2%. So that's usually where I keep my stop losses. And then what we'll do is, always try for that 6 to 8% upswing, and that's what occurred here. So that was a great trade for the club. The other one that has been a winner for everybody has been this MGY. Now we played this back a few early May. We played this one. We had some really extreme action here, large appreciation coming. But this was another good one for the club, guys. And again, we want to see this historical kind of trading range, right? It's just bouncing off the 100-day moving average here, right? Bounce, 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 bounce. That's a good level of resistance to play off. Now, where we are currently is much higher than that. So I, as a swing trader, don't feel comfortable necessarily getting in up here. Now, you could make an argument if we flip over to 1 hour. You're starting to see this similar pattern occur right on the 50-day moving average here, and it technically wouldn't be a daily moving average in this case just because we zoomed in, so it's only going to be looking at those 1 hour tick marks. But you kind of start seeing this formation pattern occur, so there might be a scenario where you can hop in here and play up to this next sort of range, but I would personally stay away from this one, and you're going to see that in our free picks for this week. But that was another MGY. That was a great one for the club. So a lot of our recent winners came off the kind of oil sector and natural resources, which we actually put on back in December is when I started trading those, and hopefully some of the club members did as well. So that is the overview there. So looking at our first free pick for this week, again, this is just one pick. We'll go over 2 of them, and then we have all our premium picks inside the club that only our premium members have access to. So if you're interested in those, definitely join the club. We have weekly discussions, daily discussions, and so we'd love to have you. But regardless, let's talk through this pick. So KMI, you can kind of see on this profile, it's just an oil and gas. Again, when you're kind of going through and looking for what you expect in the most appreciation from some of these high-flying oil stocks that are really going to be the talk of the street this upcoming week, in my opinion, we want to try to find plays that aren't too overbought, right? So from an RSI perspective, if we're looking at something with an all-time high of 22.58, this all-time high in the last couple years, I'm much more comfortable with that versus something like an MGY, which has just been on an absolute tear, right? So for me, when I'm kind of thinking through these, I like having this kind of cushion, if you will. So we have this bottom, more or less it's been kind of established that we're not going to head back there anytime soon, which can change on a dime, but we're seeing this, our moving averages all go up and to the right. That's what we like to see. We're starting to see a little bit of this historical kind of reference start playing in, right? Always being bounced off the 50-day moving average in this case. Now, what we want to look for as we go forward here, and let's actually switch to the 4 hour. That's a little bit better of a chart for us. But we're really seeing this kind of channel pattern form again. So I would say right where we are currently is probably about that bottom range. And so when we're kind of thinking through, and I'll just even draw it on for you guys right here, just so we all have context of what I'm looking at. And we can just draw it like that. It's fine. So we're kind of at the bottom of this range, right, guys? And so what I'm looking to do here is just tidy it up for you guys a little bit. I'm looking to play off this bottom range, but I actually wouldn't want to initiate the trade until we get a little bit over our half, or not halfway, but about the 25 quarter mark, just because I want that confirmation. If I don't have the confirmation of the trade, I don't want to initiate here and say we drop down another 2-3% and our trade gets crushed. So let's wait for kind of positive confirmation. When I say that, I mean the 5 and 9 day moving average. So I'll zoom in, on the 30-minute, on the 1 hour chart, just to kind of give us a sense of where we are currently. If you bring your attention over to the right side of my screen, right, I like having this 30-minute chart up here. We can even change it to 5-minute, but it gives us a good sense of what the market did last week and kind of how it closed, which might give us some indication for how it can open the coming Monday, which is tomorrow at this point. So let's be careful here, guys. But I do see positive appreciation. I think we're going to make a good trade off this one. The next trade is NRP, another natural resource that I am giving out for a free pick this week. Again, we have some few that are actually in the financial sector that I think are going to be great, but that is for premium members only. And then I have a few other ones that are kind of some hidden gems that I found just throughout the week. But in terms of what everybody's going to be looking at, in my opinion, are these high-flying oil stocks that have been really crushing it lately. So this one in particularly is, you're starting to see a little bit of consolidation at the top, which I don't necessarily like. Right, you're kind of seeing this level between, let's just call it 48.5 and 75.75, so, wherever that might be. But you're starting to see this kind of roll over of these averages, starting to see a little bit of slowdown. So I think if we can get a nice jump here, there's a clear path to the 51 range. But if we do keep seeing kind of consolidation here and a little bit of a tick down, I would probably not be interested in this trade. But another one that's just been a complete high flyer. So let's monitor this one. Now, one thing I wanted to note here is just how long this stock has been on the market. Now, I haven't done a deep dive into all the analysis of why we had such an extreme gap down from early 2000s to where we are currently. Obviously, the oil market had everything to do with that. But in terms of any kind of company restructuring, any sort of strange buyback programs in terms of their dividend or anything like that, I haven't looked into. I'm just more so looking at historical context of what we might be looking at, over the next couple months. So we'll see what happens here. But this is another one that I'm kind of have on my radar this week. And we're just going to see how the market opens Monday, Tuesday, and if a potential entry opens right about this 47 spot 4, that's where we're gonna try to make a play on. So that is it for this week, guys. I really appreciate everyone tuning in. Again, these are my I've only been doing these for a few weeks now. Hopefully you've seen an improvement. I know I enjoy talking through these things, and it certainly helps me kind of articulate all my thoughts, and hopefully it gives you a little bit better of an insight into how I try to build out my plays. Definitely visit our website. It's much appreciated. We have a blog here that you can kind of go through and view all our latest findings here. We can click on any of these and you'll have access to our recent YouTubes, recent articles, reviews, winners, etc., etc. So give it a a click through it. Let me know if you guys have anything that you'd like us to talk about, and it really does mean the world to me that you guys at least got through this far. So thank you, and we'll see you guys next week. Bye-bye.